This is John Paulamy of the Actionable Intelligence Alert. Today is Sunday, December 16th, 2018. And this week I was going to go over some macroeconomic indicators that I'm looking at and some things that I think that are shaping my thoughts as I prepare for next year. So the first thing I wanted to talk about was the fact that the U.S. stock market is basically overvalued on every single metric that you can measure it by. This is one of my preferred ways of looking at overvaluation or undervaluation, which is the Shiller PE ratio or the cyclically adjusted PE ratio. I've written several articles about this, basically taking Meb Faber's research and showing how looking at current CAPE, how you can forecast the next 5 to 10 years what returns will be in the stock market. So when you're at these levels that we're at, which is 32 or something like that, typically your 10-year ahead returns are very low single digits or slight losses. And that's just a manifestation of something that I'm a big fan of, which is mean reversion. So I'm not going to spend a bunch of time on this except to say that we are historically overvalued. However, that doesn't mean you can't get more overvalued. You can see that the most overvalued we've ever been on a PE, based on the Shiller PE, was back in 2000. So we could get significantly more overvalued and still be within a historical context. So I will talk about that some more as we go forward. Now, I think it goes without saying, I've heard some famous investors like Stan Druckenmiller and some others basically say that really the only thing you really need to really pay attention to is liquidity. And liquidity is a central bank phenomenon. I mean, we can roll back history, the tape back to 2008 during the Great Financial Crisis, and we know what the Federal Reserve did. And we can see from this chart, if you go back to how rates were cut basically to zero, and we've had almost 10 years of, well, at least 8 years of zero interest rates. This was done as a result of the Great Financial Crisis, and it certainly wasn't only the United States, but the Japanese Central Bank, the ECB, the Bank of England. I mean, between all four of these banks, somewhere upwards of $15 trillion of currency units were created out of thin air and injected into the world economy. Suffice to say, that didn't necessarily go into productive assets, but it did go into financial assets. We've saw bond prices soar as interest rates have come down, and we've seen various stock markets soar around the world. So what we're seeing now, though, since 2016 is a rate-raising cycle that the Fed is in. And they are slowly but surely raising rates. Now, what's interesting is that we've had a ton of companies basically being kept alive as zombie companies based on low interest rates. We are now in a rate raising cycle, and it will be interesting to see what happens as companies are forced to roll over their debt with actual real interest rates, and interest rates being higher. We've already seen some of the beginnings, rumblings of what I consider to be the next crisis, which will be in the corporate bond market. I plan on getting into this more next week, but suffice to say that there are a lot of companies in the S&P 500 who do not have the economic ability to service their debt at higher interest rates. And that, I believe, is going to first become a net negative, but at some point in the future will become an excellent opportunity. But that's for next week. Suffice to say that liquidity in the system is tightening as rates move higher. This is being exacerbated by the fact that because of the crisis that we endured in 2008, the Federal Reserve took it upon itself to buy U.S. government debt and U.S. mortgage debt. This is a chart of the Federal Reserve balance sheet, total assets, and you can see that to the far right, the Federal Reserve has been in a deleveraging, if you will. They have been selling assets and shrinking their balance sheet. So this is also going to contribute to a tightening liquidity. Now, if we are of the view, and I am of the view, that liquidity and these lower interest rates, along with these central banks buying assets, has been a catalyst for higher stock prices, suggests to you that making new highs or moving higher may be more difficult going forward as the interest rates are raised and tailwinds turn into headwinds. So I think people forget about the fact that the Fed is tightening their balance sheet and shrinking liquidity. These, like I said, are headwinds to the market. Now, this is a chart that I got from Steve Blumenthal's weekly missive that he puts out that I suggest that you all read. I'll put a link to it in the show notes. But it shows, it's from Ned Davis Research, and it shows basically times of recession, global recession, and it shows a indicator that tells us when we're in a global recession. And you will note that the red line is at the 70 level, and that every time that this indicator has been above 70 or above the red line, we have been in a global recession. So we are currently above 80 on this indicator, and so it's probably a good proposition that we are currently in a global recession right now as we speak. And that's not going to be verified, until we're substantially further ahead in the future. Typically, people have to go, these things are determined in retrospect, not in real time. But this is an excellent indicator to kind of, what I'm trying to do is give you a perspective of the fact that although things are going fairly well currently in the United States economically, the rest of the world is struggling. And this is an excellent indicator that has pretty much never been wrong. So something to keep your eye on, and it's kind of goes into what we've been seeing. We've heard that the United States, with the continuing good economic news, has been described as the cleanest shirt in the dumpster, stuff like that. So I do believe, though, that inevitably, if the world economy continues to struggle, that we will see this start to manifest in the United States. So what are the facts, and what are we really looking at here? Well, the facts are that the U.S. economy, although some cracks are beginning to show, it is still growing. And this is a manifestation of the tax and regulatory deals that President Trump and his administration, along with the Republican Congress, did. However, I suspect that these will begin to wear off next year. U.S. employment growth continues. As a matter of fact, wage growth is really kind of been growing and is causing concern at the Federal Reserve because of inflation. We basically are running out of skilled workers in the workforce. We're down to the convicted felons and people with less than a high school education to try to fill jobs. Every indicator I look at shows that, and that's not turning yet. That is an excellent recession indicator, by the way, or a indicator to look at for when the stock market may turn, and that's when the growth in, or I shouldn't say the growth, but when the joblessness rate or the amount of job growth begins to turn negative, or not negative, but the growth rate turns, so to speak. So you'll still see employment growth, but the percentages will start to go down. And that is a leading indicator that's very prospective for indicating when the market's going to top and when the economy is going to begin to turn down. Obviously, we haven't seen that yet, but that is something that I am looking at. Inevitably, we are going to have a recession in the United States. Inevitably, that will lead to a stock market decline. Typically, in a recession, you typically see stocks fall anywhere from 30 to 40%, and based on these overvalued ratings we're at, it's conceivable that we could see a stock market decline of 50% plus during the next bear market. I'm not forecasting a bear market right now, but I'm just giving you the averages. I mean, right now, based on what I've said and the indicators I'm looking at, U.S. recession risk is currently low. Not really looking at anything really being negative probably till late 2019 or early 2020. But we need to be cognizant of the fact that we are now over 10 years into this expansion, and we are a really late cycle. Recessions or economic expansions don't just stop on their own. They basically are killed off by the Federal Reserve as they raise rates and tighten liquidity. That's what typically leads to a recession. And as I said earlier, we are in a rate-raising cycle. So I have said this before and I'll say it again, the Fed will continue to raise rates until they break something. And I think that they have been close to doing that. And we've seen Chairman Powell actually come out and say that we may be near the end of rate-raising cycle. So I don't like to really focus on these things. I'm just bringing this up because we have to look at these things. I kind of like to look at the companies individually that I invest in, regardless of where we are in the economic cycle. But I think it's important to kind of understand where we're at and have some type of plan or view of what's going to happen so that we can help navigate through these rough waters. I think one of the wild cards really in all this is energy prices. With the fact that I was forecasting oil to be in the high 70s, low 80s by the end of the year. Obviously, we've had a 30 to 40% decline in oil prices, and this is going to be net positive to the economy, although it will be offset by the slowdown economic activity that goes on in our own shale basins. But overall, lower oil prices are typically good for consumers and help them to be able to have money to spend in other places. However, typically what we see as we go into recession is energy prices fairly high. And I suspect that that's going to be like a small tax cut, if you will, the lower oil prices. But as we go forward, I do see oil prices recovering with the OPEC and non-OPEC deal to cut production. So one of the things we're looking at is, what will the Fed do? Obviously, I go back to that Stan Druckenmiller thesis, which is liquidity is everything. If the Fed continues to tighten liquidity, at some point they're going to choke off the flow of money into the market sufficient that it will cause a recession/bear market. I don't know when that's going to be, but we have to look at what the Chairman Powell is saying, that we may be already where we need to be. I think people are getting nervous. You see President Trump tweeting that the biggest risk to the expansion and to the economy is the Federal Reserve. So these things do matter. We shouldn't just focus on them entirely, but we should be paying attention. Like I said, I like to look at individual markets and think long term, but it's important to understand where we're at. So here's a quote from what my view is for 2019. Kind of syncs up. This is put very well by John or Paul Tudor Jones, who was on CNBC about a week ago, and I think this kind of sums up how I think about things going forward. It says, I think we're going to see a lot more of what we just saw, which is a lot more volatility. It's really easy to say I'm really bearish or I'm really bullish. I kind of see a two-sided market. I think in the next year it will be, from where we are today, at least 10% down and 10% up, maybe 15% either way from where we are right now. And that's kind of how I'm looking at it, with the caveat that we may see a melt-up in stocks, a final melt-up. I think it could be a catalyst for that, could be a resolution, or at least a perception of a resolution of U.S.-China trade issues, a announcement by the Federal Reserve that they're going to pause on raising rates or pause on shrinking the balance sheet, or a flat-out rate cut. I mean, I don't see those as being very probable, but it could happen. And you know, Trump could cut a deal with the Democrats and maybe create an infrastructure bank or something like that that could further stimulate the economy. So I think, you know, same thing, bear markets usually, or bull markets usually end on excessive optimism. And right now it seems like everybody's bearish. So I think we're going to see a lot more volatility. And that's good for people like myself, speculators, because we want to buy things when they're cheap. So if we have opportunities where we have short-term bouts of volatility, like we have had in the energy market, I do not see long-term the supply of energy being sufficient due to lack of investment. And we've had an excellent opportunity to buy a lot of service companies and oil companies themselves at cheap prices. So I think understanding volatility and making it your friend is going to be a net positive for next year. Speaking to that, I want to bring this chart up again. And basically what it shows is the relation of equity prices or stock prices to commodities. And as we see, you know, we've said before earlier in this presentation that equity prices are very overvalued on a historical nature, but commodity prices in relation to equity prices are almost at an all-time low. So I like to buy things when they're cheap. I think this is where the opportunity is. This has been the focus of my newsletter over the last year that it's been in publishing, and we've had some successes. We've also had some not very good outcomes, but I think that we will see a reversal over the next couple of years as commodities rally and equity prices come in. And I think that right now the dollar is fairly strong due to the fact that we're in a rate-raising cycle and that our economy is doing better relative to the rest of the world. That will not last forever, and eventually we'll see that reverse. So that's kind of where I'm at right now. I know this is kind of boring. Talking about economics is not the most exciting subject, but I think it's imperative that you have to think about these things and you have to kind of know what drives markets. And I'm a big fan of the fact that liquidity drives markets. You know, if the Federal Reserve came out just tomorrow and said they were cutting rates by 50 basis points, the stock market would rally 1,000 points in a couple days. So if they came out and said they were going to stop shrinking the balance sheet, the stock market would rally 1,000 points. That's what it's about. As we go into next week, I will comment more on why I think the corporate bond market is going to be a catalyst for the next crisis, and also why I think that that's going to lead eventually to an ending of quantitative tightening and a resumption of rate cuts and quantitative easing, and why I think that gold is setting itself up very well for the next few years for a big run. And I'm not going to get into that right now, but that's kind of what we'll be looking at in the next call or the next show. So appreciate you listening to this. It's like I said, it's not the most exciting subject, but kind of got to set it up for the things that are coming. Appreciate the support. As I've said before, you guys have been tremendous. Keep the comments coming. I get a lot of emails. I get a lot of suggestions. People send me all kinds of good tidbits. I really appreciate that. If you have questions or comments, feel free to email me directly. I try to answer every email. And I especially want to extend a thank you to my Patreon supporters who have been supporting me. I will remind you that if you are interested in the actionable intelligence alert, you can, as a supporter on Patreon, if you support me for $5 a month or more, I will send you the current month's actionable intelligence alert stock pick. And that way you can get a flavor for what we are talking about in the newsletter. So again, thanks for the support. Please hit that bell, hit the subscribe button, And we thank you very much for this great year that we've had here, starting this thing from scratch. And I've really enjoyed it, and I hope you have too. We'll talk to you next week. Thanks, guys.